The very first YMYW live webinar was so much fun, we've decided to do it again. Join us Wednesday, May 27th at noon Pacific, 3 p.m. Eastern Time to get your money questions answered live and on the spot by Joe and Big Al. Visit the podcast show notes at yourmoneyyourwealth.com to sign up. Hit that link in the description of today's episode in your podcast app to get there. Today on the Your Money, Your Wealth podcast, Joe and Big Al talk about financial planning strategies that come from the CARES Act stimulus package, specifically the provisions on coronavirus-related distributions from retirement accounts and required minimum distributions, or RMDs. Plus, the eagle-eared listeners of YMYW have plenty of clarifications, corrections, and questions about dependents, thanks to episode 271. And the fellows review two very different market volatility strategies. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
I want to thank everyone for joining us on the webinar this week. First one, thought it was okay.
It's fun.
I thought it was great.
Enjoyed it.
Yeah, we have a couple of questions and comments that we'll rifle through here that we weren't able to answer. Tina writes in, if a married couple owned for 2019 and received the $2,400, does the tax credit increase that they might owe for 2020?
What? They owed for 2019.
Owed for 2019. If they owed taxes in 19 and they received the $2,400, does that tax credit increase what they might owe for 2020? So basically, I think they're asking about the clawback.
Or does it add to earned income? Answer's no.
Yeah. So essentially, if you qualified to receive the $1,200 stimulus payment per person or $2,400 married couple in 19, regardless of what your income is in 2020, you don't have to pay any of it back. It doesn't affect your taxes.
Cool. Batman, hi guys. Does the $1,200 have to be paid back to the gov? And if so, how? No clawbacks. So if you got your $1,200 and you make more money in 2020, I think a lot of people are going to probably do conversions or something, it seems like, for this year.
Yeah.
They're seeing the writing on the wall, and then all of a sudden my income is going to be higher in 2020. Do I have to pay the thing back? If my income is higher in 2020, if I received it from a 2018 or 19 return, the answer is no clawbacks. Batman, another one. What about investing your cap gains in qualified opportunity zones, especially if you have no losses against which to offset your gains? Well, you could do that. You got like a 30-second little response for Batman?
Yeah, a qualified opportunity zone. That's investing generally in real estate in a opportunity zone that's considered like lower, disadvantaged areas. I think there's around 8,000 or 9,000 such areas in the United States. So here's the basic rules: is that you can take your capital gain. Like, let's say you sell a piece of property for $1 million and have a $400,000 gain. All you have to reinvest is that $400,000 gain, and then you don't have to pay any tax currently on that gain, as long as you invest in a qualified opportunity zone. Now you have, if you hold the investment at least 5 years, you get 10% reduction on your gain. If you hold it 7 years, you get another 5%, so 15% reduction on your gain. But you do have to pay the tax in full at December 31st, 2026. So it would be coming. So it's not a permanent deferral, but it is a deferral. But the cool thing about opportunity zones is if there's any future gain on that investment, you don't have to pay any tax on that. So that's the basic rule.
Okay. So Tim, if get laid off from one of two jobs working, can you file for unemployment for the job laid off from due to COVID-19? Answer is yes. Absolutely. File for unemployment on the other job that you lost.
Yeah, you can even file if you still have your job but are working less hours.
My college-age daughter is claimed as a dependent on her tax return. She lost her on-campus job when the campus went viral. Her earnings paid... Oh, viral. Did I say viral?
Yeah,
virtual. Sorry, virtual.
That's good.
Virtual. Her earnings paid for some college expenses. So now I am. Since she is part of our economic unit, I think her lost income is a virus impact. What say you? I don't know. I think so.
I think it is for her.
Yeah.
I'm not so sure it's for you, Craig.
Go for it. Christine, she writes, who cut Joe's hair? Looks good.
You haven't had a cut for a while, right?
I got a little. No, I have barbershops, Alan.
I know you own barbershops,
and so I employ barbers, and then so I had one come to my house.
Got it.
But it was a while ago. It was about 3 weeks ago. So now I kind of put a little bit extra stuff in it.
Got some nice gel.
Yeah,
I mean, nice. I'm looking at it right now. It's just amazing.
Looks great. Nick writes in, Joe's board looks like my 3-year-old's artwork. Thanks a lot, Nick. It's called the tax control triangle.
I thought it was pretty good.
I thought it was beautiful.
Yeah.
People like to take pictures of that.
They do.
Hopefully you got some out of that.
I actually do. When I meet with clients, I do that on paper, and it comes out way messier. And sometimes people want me to sign it and keep it.
Oh, wow.
Yeah.
Autographed.
I mean, that white paper, there's been multiple times in classes where they at the break, they come up, they take pictures of the stuff.
Yeah.
And I'm like, Are you kidding me? I'll take my shirt off. Take a picture of that.
I don't think that's appropriate for this.
So this is from Perry from South Jersey. Dear sirs in Andy, just want to comment on my satisfaction with the part of the CARES Act, namely suspending RMDs. I should point out that I'm comfortable with investments in Roth, traditional IRA, inherited IRA, and non-qualified funds. Fearing significant paperwork, I was reluctant to suspend my inherited RMD distributions that I received from 2 sources. I did call each and was delighted to find they could do suspension in minutes over the phone, and the distribution would resume in January 2021. Tax-wise, this means instead of taking $30,000 as a taxable inherited IRA RMD this year, I will do a Roth conversion of $30,000 and pay the same taxes, mostly in the 22% tax bracket. I am constantly trying to keep taxable income low to avoid Medicare surcharges, loss of senior property tax freeze, tax bracket creep, and even got the recent full $1,200 in rebate. Just wanted to say how easy this is. Your loyal and obedient financial servant.
Wow.
Wow, Perry, thank you.
That's a very nice email. Good start. And I think Perry, you're doing a lot of the right things.
So, I don't know why I thought it was going to be a pain in the ass to suspend his RMD.
Well, it turns out it wasn't.
just pick up the phone and say, please stop sending me money.
But you never know, right? Because you have this image that you got to talk to your custodian, and they send you some paperwork. You fill it out. You send it to the wrong place. You send it again. It's the wrong paperwork. I can just imagine that's what he was thinking.
So, but a couple of things, Perry, is that he's got an inherited IRA that he suspended the RMD on. It sounds like $30,000.
Right.
He is also have another IRA that he's doing the conversion on. So hopefully he didn't convert the inherited IRA because you can't do that. You can't do that.
That's right.
So a couple of high notes here that Perry's talking about in regards to the CARES Act. So they suspended required minimum distribution, or the Act did, I guess, or the IRS, that you do not have to take a required minimum distribution this year, either out of an inherited IRA or your own IRA, 401k, 403b. So they suspended them. So you do not have to take it. The reason being is that for seniors, I guess, that saves you a little bit of money in tax if you don't pull the money out. But I think what Perry's doing is better planning, because we're in all-time low tax brackets. Where do you think tax rates are going to go after this storm?
Well, of course, we never know. I will qualify it that way. But it does seem we're adding trillions of dollars to our national debt on top of what we already had. So I don't know where we're at right now, Joe. It's probably 24 trillion, 25 trillion. Someone's going to fact check me. It'll be 27, whatever. But it's a big number. And so how do we pay for that? There's a couple ways. You can increase taxes. That's one way. You could also print more money, right? But that causes inflation. And that actually is no good. Neither alternative is good at all. So usually what happens is it may be a little combination, right? But it seems to me that it's likely that taxes will go up at some point in the future, just because we have all this debt that we got to pay off.
So Perry's saying, all right, well, I was already going to pay the tax on a $30,000 distribution from a required distribution. I'm going to take $30,000 from my IRA and convert. mostly in the 22. Perry, I would go back and convert to the top of the 22 because I think it'll be a blessing that you'll ever pay 22% in tax as a single taxpayer.
Yeah, if Perry is in the 22% bracket now, he'll be in the 25% bracket in 2026 when the rates come back. And that's just the old rates coming back. And that what we're suggesting is, or what we're kind of wondering is, will rates go up from there? And the answer is, they sure could, because they've been a lot higher. In fact, we're kind of, I wouldn't say we're at all-time lows, but almost all-time lows in the history of the IRS. And so you think about, when do you want to do a conversion? You want to do a conversion when your income is lower, when the tax rates are lower, right? Which is what's going on right now. The
account balance is lower.
Account balance is lower, so you get your recovery in the Roth, which is tax-free. It's like, I hate to say the word perfect storm because it's so overused, but because I'm going to say it. I already did say it. It's a perfect storm to do a Roth conversion right now.
So, but he's also worried about Medicare surcharges. So what I forget what law that's under, IRMA or something like that. So you have a little bit of an, depending on your adjusted gross income, they increase your overall Medicare premiums.
Well, they do. And so at various income thresholds, and if you go over by $1, then all of a sudden your Medicare premiums in 2 years from now are going to be a little bit higher. Like for example, let's just go with a married couple. And it's always a 2-year look back. So for 2020, they look at 2018. So for a married couple, if their income is below $174,000, modified adjusted gross income, then they pay the lowest Medicare monthly rate, which is $144. If they go above that, it goes to $202. So let's just round numbers. It's about a $60 increase, right? So 60 times 12 is a little over $7,000 of $700 of extra Medicare. So I would just consider that like an extra tax and calculate what this impact is. And I think you'll find in the 22% bracket or even the 24, it's still a pretty good deal.
Yeah, it's cheap. I mean, you just take that extra, the Medicare surcharge, and then you just call that a tax.
Yeah, just add it to what the expected tax is, even though you won't have to pay it for 2 years, but it's coming.
Right, it's coming for 2 years, and then if you don't do a conversion the next year, then your Medicare premiums go down again. So
yeah, exactly.
You might want to take a pretty good chunk out 1 year. You just have that surcharge for the 1 year.
Right.
All right, Perry, thanks, buddy. Appreciate you chiming in. Part of the show here. We got Mark writing in from San Diego. He goes, "Hi, Joe, Alan, Andy. Hope you're all doing well. I just finished listening to episode 271. You remember that one, Al? It's pretty good.
It was probably great. Probably recent, right?
Is your arm getting sore, Andy, from holding up that clock?
Yeah.
All right,
no, backwards for you?
I'm good.
Okay.
I'm good. Yes, I'm good.
So
She's holding the clock up through the Zoom thing, and you can see it. Yeah, I can see it shake.
So you and I are together, but Andy is safely in her home.
We got, "Hi, Joe, Alan, Andy. Hope you're doing well. I just finished listening to episode 271 and had an idea regarding coronavirus-related distribution. My current 403B has high custodial service fees and limited investment choices. Since I qualified to take an early withdrawal penalty-free furloughed, what do you think about taking the distribution, placing it instead in my more preferable Vanguard IRA or brokerage account? Better choices and significantly lower fees. In deciding before or at the end of 3 years whether I want to pay it back or pay the taxes. Either way, I will at least save on those annual 403B custodian fees up to 3 years. What do you think? Thanks. And kick-ass Seabass." There you go, Mark.
Seabass, yeah.
Kick his ass, Seabass. Dude, Mark, you're right on track. I would absolutely do that if I were you. If you qualify for a coronavirus-related distribution, CRD for short there, Al.
Very good.
Take it out of the 403B. The only catch with that strategy is that you want to make sure that the 403B is eligible for a distribution. So it's still up to the plan doc in some cases, but employers are putting that language in for these coronavirus related distributions. So I would take the $100,000 out. It doesn't have to be deposited back in the 403B. It just said it needs to be, if you want to pay it back, it needs to be deposited into a qualified plan. So that's an IRA. So if you want to put it into your IRA at Vanguard, another strategy there too is that then it's sitting in the IRA. you might, over the next couple of years, slowly convert the IRA into a Roth IRA. Just going back to kind of the same, theme as Perry. It's a lot easier to convert an IRA to a Roth IRA versus, your 403B that you might be stuck in.
Yeah, I like that. And Joe, just one more quick thing is if he does, Mark, if you do put it in your brokerage account, you do have 3 years to put it back into the IRA, but you have to pay 1/3 of the tax this year, 1/3 next year, and then 1/3 the following year. So if you put it all back, you basically will then get a refund for taxes you paid in year 1 and year 2. So just be aware of that.
Or it depends on how much money that he has too and how old he is. It might make sense to take the distribution, put it in a brokerage account, pay the tax over 3 years too.
Yeah, maybe.
Right? Because with individuals that have zero tax diversification, that have everything in a retirement account, he's got a 403B, so he might have a pension as well. Right? So usually if it's a school teacher or something like that. So if he's got a pension, maybe the spouse has got Social Security, they might have large fixed income, and then all your liquid assets are in a retirement accounts. Using this CARES Act to kind of maneuver your assets around, is I think a good idea. And also it's a good safety cushion. Who knows what the hell is going to happen to us 6 months from now, but you have to make the distribution in the year 2020.
We do still have a few more questions from last week's webinar, which we will tackle either in an upcoming podcast or on the next YMYW live webinar on Wednesday, May 27th. And keep in mind, these YMYW live webinars, they are exclusively for you, the folks that listen to the Your Money, Your Wealth podcast. Visit the podcast show notes at yourmoneyyourwealth.com to sign up for free and join us live. Hit that link in the description of today's episode in your podcast app to go to the show notes and get yourself a copy of our free CARES Act guide while you're there. Now, you know how Joe always said this podcast is not advice, it's just a couple kids having a chat, making a few suggestions. That especially applies to episode 271.
All right, we got David. He writes it from New York City. Hopefully you're safe and sound in New York City, David. He goes, "Hi, everyone. Been listening to the podcast for a year or so and always enjoy the info in the banner. Great to get some laughs along with solid financial advice. My question is on a topic that came up in episode 271.
Popular.
Dude, killed it. 271 is a very popular episode.
Right,
it's kind of going to archives. Everyone's referencing 271. I mean, people are walking down the street. They're like, hey, 271, great episode.
Yeah, you know 271? Yeah, I know it.
About dependents and the stimulus payments. You answered a question from a college student who wanted to know if she'd get a check if her parents declared her as a dependent. You advised that her parents shouldn't because there'd be zero benefits since the tax law changed, and since that would make her ineligible for the stimulus. That made me wonder if our accountant who filed our taxes a few days before the CARES Act was passed missed the chance for my son, a 19-year-old full-time college student living on campus during the school year, but otherwise home and with no earned income except for modest distributions from an UTMA account, to get a $1,200 check this year. He was listed as a dependent on our return, but appears that there was at least some benefit to us, a $500 tax credit, line 13A on the 1040. Of course, it's not $1,200 in my son's pocket, but would he even have received that much with only a few $100s of income from those distributions? Also, does the fact that he's not living independently make him ineligible for the payment? Meanwhile, if my son is not listed as a dependent for 2020, though he'd still not be living independently, would he be eligible for a check then because he didn't get anything in 2019? He may have some earned income from a summer internship if COVID-19 doesn't torpedo the internship program. It's live for now. In addition to those investment distros, but that wouldn't be huge. Thanks for the info. Stay well." All right, there's a lot of meat on the bone here.
Yeah, there is.
All right, so I guess in episode 271, there was a college student that her parents were claiming her as a dependent.
Right.
Kelsey, I happen to remember.
Kelsey. And we were like, Kelsey, probably shouldn't have your parents claim you as a dependent because there's no benefit for the parent to claim a child over the age of 17 or something like that to be claimed as a dependent.
Yeah, I do. I think that is what we said, and that would have been a wrong statement. So let's clarify.
Okay.
I got called out on it, and I'm okay with that. I'm not perfect. So here's the rule. The rule is if your child is 16 years or younger by the end of the tax year, you get the child credit of $2,000.
Yes.
Okay? When they're 17 and 18, then you get $500. And if they're all the way up to age 23, you get $500 as long as they're a full-time student.
A $500 tax credit.
$500 tax credit, right, for child credit. That is a correct statement. So, and you also get $500 for other qualifying dependents, like let's say your parents, for example. So let's talk about a dependent, because that's really pretty confusing in and of itself. Is when you have a kid 18 and under, they're a dependent. When you have a kid up to age 23 and they're full-time student at least 5 months out of the year, they're a dependent. And when you have a parent where you pay at least half of their support and they make less than about $4,000, they're a dependent. So you do get a benefit. Now in this case, I will still stand by the if David had not claimed her as a dependent, then she would get $1,200 potentially, and he would be out the $500.
But he would his kid is only getting a little bit of UNTMA, right? He's not working. He's not employed. He's not living independently, is what David said.
Yeah. Well, sure.
I mean, his kid, he's like,
most kids in their 20s are not living.
You are not living independently at all. So if he's not filing a tax return, he's not going to get the stimulus.
Yeah, you'd have to file a return.
You got to file a return, unless you're claiming Social Security benefits.
Yeah, but to get back to one of the questions in 2020, if David's daughter files in 20 with enough income, then she would qualify for the stimulus then, even though she didn't get it in 19, because it's really it's an advance payment for 2020.
Right. It's a 2020 tax credit. And so if the child then files a tax return in 2020, then they would receive it's a refundable tax credit based on the 2020 return. So David got the $500 this year, got his stimulus, right? But then next year, if he doesn't claim his child and the child files a tax return, then the child would then receive the $1,200 tax credit. It's a refundable tax credit.
Right.
So he would receive the cash then after he files the 2020 tax return.
So one other quick caveat, and some accountants would interpret it, if you qualify as a dependent, you have to be claimed as a dependent. So just check with your accountant to see their interpretation.
All right. So we got another one from Tyler. He didn't give a location, but he goes,
which is unacceptable.
I know, it's totally BS. He goes, he's like, "Hello, Joe, on a recent podcast, you said that claiming a 17-year-old is a $2,000 tax credit. It's my understanding that 17-year-old is worth $500 and your dependent needed to be 16 years or younger to receive $2,000. Am I wrong?" Of course you're not wrong, Tyler.
I'm guessing that was 271 again.
I don't know. I don't know why I said 17.
Well, it's in the heat of the moment. It's easy to
17 and under, maybe, right? Because it's like when you're talking about the CARES Act itself, they can't receive the benefit for 17. It's not 17 years old, right? You have to be younger than 17.
So it's easy to think that should be 17 and under, but it's actually 16 and under. It has to be under 17.
Under 17, Tyler.
As of December 31st of that tax year.
So sorry for the confusion there. So yes, you are accurate. It's $500, $2,000. If you are under the age of 17, then it's the $2,000 tax credit. As long as you qualify under the adjusted gross income limitations, which is quite large now. It's several $100,000. They increased that with the Jobs Act. So my bad, Tyler. So just a miscommunication of words there, but he is accurate.
By the way, that child credit phases out at 200,000 of income, single, 400,000 married.
400 married, yeah.
Yep.
So, okay, we got Todd from Williamsport, Maryland.
Same question.
Joe, Al, Andy, love the show. Have binged every episode. I do have a correction for you. In the last two recent shows I've listened to, you have both agreed there is no advantage to claim a dependent over 17 on your taxes. I do have a 23-year-old daughter that just graduated college, and I ran the numbers both ways. She does get a $500 dependent credit and a credit for the education expenses for both federal and state, totaling $2,700. If I don't claim her and she claims herself, she is not eligible for any of it. Regardless of the stimulus check, we come out ahead by claiming her. I verified my numbers with my tax preparer, and they came out the same as mine. Well, Todd,
we stand corrected.
We stand corrected.
Yep.
Very good.
Fact check. We're called out on this.
Fact check. We just laid an egg on this one. Jesus.
Apparently. Don't
My
listen
God.
to 271. We thought it was a good episode. Not really.
Yeah, like these guys are idiots. My God. But you'd know if you have a 23-year-old daughter? No, Todd, because I have a 23-year-old girlfriend.
You claim her?
I claim her, yes.
Oh, TMI.
Oh, boy.
All right, cool.
All right,
Moving
so let's go.
Where do you want to
go? All right, so is that all the CARES Act? So we got the CARES Act. We're good.
Yeah, I think
There's Jeremy at the end of that same page asking the same question.
Really?
Oh boy. Another one telling us.
Another
We don't
one.
know what
Oh,
we're
Jeremy.
talking about.
Hello, Joe, Al, Andy. I've seen conflicting information about the stimulus payments with regards to dependents. If the restriction on whether someone claimed you as a dependent, or is it based on ticking the box of the what is ticking?
That'd be like
Ticking the box. Can someone claim you as a
Ticking?
dependent?
That'd be like TurboTax. You got to tick the box.
Oh, tick the box, or I say check the box.
yeah,
But
but
you can tick
it
the box.
if you want.
Sounds like
Start
kick the
ticking
bucket.
More boxes. Tick some box. Can someone claim you as a dependent? Basically, should I amend my taxes to stop claiming my college kids, or is there no point? There has been no reason for me to claim them for some time other than inertia. Even under the old tax laws, I was over the income limit for potential exemptions, let alone the child tax credits. Thanks. Love your podcast. So I guess it depends on how much money Jeremy makes to claim, right?
Yeah,
if he makes over a couple $100,000, it probably doesn't.
Yeah,
if he's married, 400.
Right. Yeah, 200 single, 400,000 married. That's where it starts phasing out. And I think if I'm not mistaken, the phase out, and I'm going to get fact checked on this, but I think it's 200,000 to 240 for single, and maybe it's double that for married. But at a certain income level, there is no benefit whatsoever.
So, all right.
There is one more stimulus question. It's on the very first page. It's the second question.
Oh boy.
I put it as stimulus instead of CARES Act. I should have known better.
Got it.
Okay.
Okay, I'm 69 and collecting. This is from Robert. Robert doesn't tell us where he's from. I'm 69 and collecting Social Security benefits. I did my 2019 taxes, but did not get a refund I had to pay. Sent the IRS a check. I'll be getting a stimulus payment, and how?
Will I be?
Will I be?
Yeah.
No. Getting a stimulus payment, and how? Love your YouTube videos.
YouTuber.
YouTube.
Awesome.
Just binging the YouTube.
Nice.
Yeah.
So I would say, Robert, your question was, I guess we didn't get to it the last couple of shows. This was asked on April 14th. You probably got it by now, is what I'm guessing. Since we're a little bit late here. We have all of the news some of the time as expedient as we could possibly do. How about that?
God. There's no good news without Gary Good News.
Wow, that's
Now,
going back.
The only reason,
Remember
Robert,
that show?
Oh, yeah, absolutely.
The
Very good
Great
news.
Space Coaster? Right?
Yep.
Something like
Came
that.
on sometime right after Sesame Street, didn't it?
You got it.
Yeah.
I was going to tell Robert that if his income was too high for 2019, then he wouldn't necessarily get the stimulus. If it's lower in 2020, he could get it then. But I'm guessing because of the date of this question, he probably already has it.
Okay. Kind of powering through today. We're getting caught up.
Yeah, we got a little behind, didn't we?
A little bit. I mean,
Yeah.
they're rifling in, and when
Yeah,
you
they are.
screw up an episode with one thing,
I know.
I mean, you get 14 emails right there.
That's a good way to get emails. Screw it up.
Just-
Have people disagree with
yeah,
us.
just blow yourself up.
Right.
Just, it's not easy. I mean, it's not hard for us to do that. All right. Where are we at here? John from
Yeah.
San Diego?
Yep.
Okay.
And he read a question on my birthday,
You did.
April 17th.
All right. Is that like a sick plug for me to say happy birthday to you?
Yeah.
Got
Are you
it.
going to sing?
No.
Okay.
Um,
That's a relief, by the way.
You got it. Can I legally convert all or part of my RMD from my IRA to my Roth IRA? Naturally, I would pay the tax on the IRA withdrawal, use part of it for living expenses, and reserve the rest for future use in my Roth. I've received conflicting information regarding this issue. I appreciate your advice. Feel free to use your question on the show. Thank you for all your consideration. So can I legally convert all or part of my RMD from my IRA to my Roth IRA? The answer is no, John. An RMD is a distribution. You cannot convert a distribution. However, you can still do a Roth conversion, but you cannot convert a required minimum distribution. However, there is no, yeah, right?
Yeah, so that's what I was going to say. There's a workaround for 2020, and that is you do not have to take your required minimum distribution. So you could take what that would have been and convert that, and you end up with the same thing or all or part of it. That's up to you, but that's only good for 2020.
Yeah, can I legally? Yeah, so that's only 2020. So, you know, there's talk too that I'm seeing is that they want more RMD relief. I'm interested to see that they'll probably do something different with RMDs down the road.
Yeah, maybe. You know, the interesting thing to me is most people take more than their RMD anyway because they need it.
Well, here's what they're going to do, Al. This is my theory.
Oh, you got your okay.
If you have an account balance of under $250,000, they're going to waive all RMDs.
Yeah.
You will not have to take an RMD
because you're going to take more than that.
Because you're going to take more. You're going to deplete the 250 over your lifetime.
Right. So it doesn't even matter.
If you have, let's say, an IRA of $500 or $1 million more, the RMD is going to double on you.
Yeah, maybe. Right.
Right. They're going to force more of those dollars out.
They want their tax money.
So it's going to affect, 80% have probably could eliminate the RMD, and then the 20% they'll get killed.
Well, let's say you're you got a big pension, so you got $200,000 saved in your IRA, but you never need it. So then you would basically benefit from that rule, if that's what happens.
Okay, so that's like 0.4%.
Or what if you're really frugal?
Yes.
You can live off your Social Security.
I suppose. I mean, there's all sorts of different things.
Yeah.
But you probably have more than $250,000 in a retirement account if you're pretty frugal, and you can live off of your Social Security.
Not if you made minimum wage.
Oh, okay. All right.
Just saying.
Yeah, there's a lot of, I guess we can say a lot of things.
And we're talking about a rule that's not a rule. It just came out of Joe's head. So don't go Google it.
Right.
Where's this rule?
Hey, I listened to a show 274 where Anderson's talking about they got rid of RMDs.
Yeah, and if it's 500 or more, you got to take double. And when's that go into effect? No, this is just us, a couple guys talking.
So if I don't take double this year, do I get, what happens? Bill from Mission Viejo. So it goes Big, Al, Joe, and Andy. I have a couple of questions about RMDs and QCDs for 2020. I read that the CARES Act exempts the requirement to take an RMD for 2020. But if you do a withdrawal from an IRA in 2020, is some or all of it considered an RMD? If it isn't, it seems like a good opportunity to do a Roth conversion. What say you all, wise ones? If you skip doing an RMD for 2020, can you still do a QCD up to the limit, correct? Great podcast. Keep them coming. Thanks, Bill. Up to 5 from San Diego and Mission Viejo. You got it, Bill. Right on target there, buddy. Yes. If you're not, the RMDs are suspended, and so it's a good time to do a conversion. Absolutely. Can you still do the QCD? The answer is yes.
Yeah, the answer is yes. And what's kind of weird to me is the Secure Act changed the RMD age to 72, but QCD didn't change. So it's still 70 and a half for that. So even though theoretically you don't have an RMD requirement, which is true for everybody in 2020, you can still do the QCD up to $100,000 a person.
So if you want to give $100,000 of the retirement account to charity, you can do so.
So the way that goes is it has to go directly from your IRA to charity. You can't get the cash and then give it to charity. It doesn't work that way.
Cool. All right. Right on target there, Bill. Thanks for the question.
I'll say it. Very happy belated birthday, Al. I'm glad you're here. Anyway, hey, thanks to everyone who caught that fumble in episode 271. It is awesome to see how many people actually listen to YMYW so closely. Click the link in the description of today's episode in your podcast app, then click Ask Joe and Al on Air in the podcast show notes, and keep sending us your questions, comments, suggestions, stories, and yes, even your corrections.
Okay, let's move on here. Market volatility. Joseph replied to a prospecting marketing email. So we have a prospecting marketing email. Thanks for that. It's all this stuff.
That's in blue. That was for you.
Oh, I don't have any.
Oh.
Okay. Is all this stuff going on for 2 or 3%? Why not just live off your cash in the big straight money? Plus your Social Security. All right. Well, yeah. calls. Is this the one with the voicemail too?
Yeah.
Well, I think that means if you can make 2 or 3% on your cash in your bank,
why not?
Call it good.
If you can.
And yeah, if you got it locked in, and if that's enough income plus your Social Security, how about it?
Yeah.
But one of the problems with that is that we know it's over the long term, it's not going to keep up with inflation. So that's why we usually have people invest in some other stuff too. But yeah, I mean, if someone has plenty of money and they don't need to take risk for the rest of their life, why do it? I agree with that.
I said that once and people freaked out.
I do remember. Well, you said it differently.
I know.
You said go to cash. I'm not saying that. I'm not saying go to cash. I'm just saying if you got plenty of money and
they should have followed that advice, to be honest with you.
Yeah,
because I timed it.
Yeah, as it turned out, right?
Okay. We got Zachary from Durham, New Hampshire. Never been there. Never even really heard of it. Okay. Hey, Joe, Al, and Andy. Thanks for producing such great content. I really enjoyed listening to your podcast on my way to work. All right. So he's chilling. I wonder what he's driving.
What kind of dog does he have?
You're right.
Right?
But he's only 23, so he's probably not something really
Honda Accord.
cool, yeah.
Hey,
what do you think?
Keep riding. Wait reading.
Civic.
Wait till you see what he says.
I think
A little Civic?
Nissan Sentra.
Oh, Nissan Sentra.
Yeah, I think so.
Yeah. I don't know. All right. Cool. Well, now I'm just thinking about New Hampshire in Zachary, just chilling.
Okay.
Just driving to work, listening to this podcast right now. And he's probably like, holy stuff.
Yeah,
these guys talking about
good
me.
stuff because apparently he wants to become a CFP. Maybe after listening to our show.
Yeah. Oh, wow. You skipped ahead here, Al.
I know.
I'm 23 years old, and I hope to eventually become a CFP.
Certified Financial Planner.
Wow.
Exclamation point.
Yes.
Wants to be just like Joe.
Just like me. I'm a certified financial planner.
How about a CPA?
That sounds pretty boring.
It's really fun.
Although I completely understand the question I'm about to ask is going to make you both go, yikes.
Oh, okay.
Ooh. Well, first of all, Zachary, I don't think I've ever said yikes
I want to see it.
in the history of my life.
Let's see if you say it on this one.
All right.
Maybe I'll say it.
I've been contributing 20% of my 401k for the last 2 years. Let's say I want to light a fire in my investments. Yeah, I like that. But because I'm younger, don't have the income to support contributions outside of my 401k. Purely hypothetical. With interest rates so low, say I was able to take out a $100,000 HELOC at 2.75% variable tied to prime for 25 years. Being young and able to take advantage of market volatility, why would it be ill-advised to use those funds in a brokerage account invested in large index funds like the S&P 500 or a well-diversified portfolio? Love to hear your thoughts. Thanks again. Zachary, well, best of luck on their career path to becoming a certified financial planner.
Are you going to say yikes?
Yikes! Zachary!
Okay, good. I can sleep now knowing you said yikes.
Oh,
So can Zachary.
leverage. Ooh, what he's talking about is he's gonna take some money out at 2.75%.
How does Zachary own a home at age 23?
I mean,
This is what I'm saying. He probably drives a
well,
Lexus.
I think in Durham, New Hampshire, they're giving them away.
Expensive.
Yeah, he's probably cruising around in that little Honda Accord, chilling. I don't know. I mean, so here's the deal. People do that every day, but they don't necessarily take a HELOC on their home. They open up like a margin account in their brokerage account. So they're using other people's money to potentially earn more than the cost of debt, which you realize is pretty cheap. The only problem is that if that $100,000 goes down to $50,000, you still have your HELOC payment. And let's say you lose your job. You don't become the famous CFP that you want to be. And then all of a sudden now you have this extra $100,000 debt that's now worth $50,000. So those are the issues. I don't hate the idea, to be honest with you, because people take a $100,000 HELOC out of their house every single day and then they buy crap with it.
Yeah, I suppose.
They buy let's buy some jet skis.
At least he's trying to invest in it.
Right.
Yeah. So
Darth Vader masks.
But HELOCs are variable, right? So that's a little scary. We're at all-time low interest rates. Where are they going to go? Of course, we've been saying that for a decade or more. So maybe maybe it's the new normal on that.
I mean, look at the national debt. I mean, if they increase interest rates, there's no way we would.
The country's bankrupt.
We would blow ourselves up.
We got to keep them low. I don't know. So here's my issue. Speaking from experience, I have
of leverage.
Yeah.
And burning your shorts.
Yes.
Got it.
So I bought 2 single-family homes in Phoenix for $150,000 each, and I put what did I put down? Put down 10%. Right. So I was 90% levered. Eventually, one of those went up in value, so I refinanced it to pay off because I had to do 2 loans, an 80% loan and then a 10% loan. Remember that stuff? And so then, so I was kind of...
It's better than an 80-20.
Yeah, I was kind of leveraged. And of course, since I had some equity, I took a little out so I could buy my Mustang.
Did you really, Al?
Yeah, it was a convertible.
Yeah.
Oh, wow.
Actually, I got the Mustang on another strategy, which I'll be glad to share. That was a strategy. Anyway, so... But then the market value probably went up to 200, 225. But then the Great Recession hit, and the market value went down to about 80,000, and my loan was about 150. And all of a sudden, my renters could not afford the rent payment, so I had to lower the rent, including one who I had to evict. And it's like, it's painful. It can be painful. Just be careful of leverage, is what I'm going to tell you as an older guy.
Because then it's like you got this debt that you're paying on. The market value underlying that debt is lower than the debt that you're paying.
Yeah.
And then your renters that you thought were going to pay for everything is now gone.
Yeah. Yeah. Now this is your home, so you don't have a renter, but if as you just said, Joe, if Zachary loses his job, it's kind of same. Now you can't afford the mortgage.
Yep.
And then you're not going to be, and the stock market will probably have crashed at that point, and you're thinking, why did I do this? Right. So just be careful. On paper, it sounds fine. I wouldn't do it myself based upon my own life experience.
But he's 23. You were doing this in your 30s and 40s.
Yeah. So, I'm just saying, don't do it.
Yeah, he had a little empire.
Well,
he's going to retire.
He's
going to retire at 55. Look at him now. He's still grinding away on this podcast at 62.
I remember when I bought my first rental at age 28. And my grandmother said, don't get too levered. And I remember thinking, that's just an old person talking.
Yeah, she's an old lady.
Now I'm the old person.
All right, Zachary. Good luck with everything. If you have any more questions or just want some advice in the industry of becoming a CFP, more than happy to help out, reach out, do whatever. So you know where to find us. All right. Well, hey, that's it for us. Thanks, guys, for joining us on the webinar. Thanks again for your questions on the podcast. If you want us to do more webinars, you might be able to con us into doing a couple more during this COVID stuff. We got these things dialed in. So have a wonderful week, everyone. We'll see you next week. Show's called Your Money, Your Wealth.
Got a couple derails at the end of the episode, so stick around while I tell you that Your Money, Your Wealth is presented by Pure Financial Advisors. Click their free assessment button at yourmoneyyourwealth.com or call 888-994-6257 to schedule a free financial assessment video conference with a certified financial planner from Pure. Again, just visit yourmoneyyourwealth.com or call 888-994-6257 to schedule your free financial assessment. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Middle of May, still quarantined. It's all right. Getting through it. One more day. That's what I keep saying every morning.
One more day? Yeah.
One more day closer.
One more day closer to
normal. Yeah.
Turns out normal is going to be gradual, I guess.
Yeah, or ever. We have a new normal.
A new normal?
Yeah, and I'm fine with the new normal.
Well, eventually we'll have a vaccine and we'll have treatments, so I'd say we'll have normal someday again.
Okay. What do we got? I don't even know. How much time do we got?
You got as much as you want.
Is this a freebie or
it's
just
a free for all?
Okay, cool. All right.
We can go as long as we want?
Yeah.
Well,
Well, within reason.
Okay.
You can go 20 minutes if you want.
Wow. I never got that right before.
Have you been to New Hampshire at all?
No, don't even know where it is on the map.
Oh, wow.
I've been to Vermont. Actually, we drove through New Hampshire.
New Hampshire's a small little guy.
Yeah, it's right next
In
to
the
Vermont.
Northeast.
Yes. Well, yeah, I knew it's northeast, but
You said you had no idea where it was on the map.
well,
I was
couldn't-
worried about you, Joe.
Yeah.
So
Well,
I
it's
have
like south of Maine and north of New York.
Okay.
That's kind of true. Depends on what.
Aren't Vermont and New Hampshire the ones that are like side by side that are
I believe.
upside down?
Yes.
opposite?
I
Yeah,
believe.
they
Yeah,
are.
they're shaking hands or something.
Anyway, we flew into Boston last fall, and Anne has a cousin that lives in Warren, 2 cousins that live in Warren, Vermont. So we had to drive through New Hampshire from Boston to get to Vermont.
Did you stop by Durham and talk to Zachary?
If I would have known at that time he was there, I would have been glad to.